Okay, so you have entered into the retirement income planning webinar, and just wanted to throw up a few statistics here that hopefully you've had a chance to look over. Um, they're basically just around retirement planning and those that have feel like they're on track and have done financial planning and that type of thing. So I just thought those were some pretty interesting statistics. This is the retirement income planning workshop, so hopefully you are in the right place. These are just some necessary disclosures. So some of the basic questions that generally retirement planning starts with is, really everybody has different ideas of what retirement looks like. And, some of the basic questions that you might ask are what does retirement mean to you? That is, what do you want and what do you expect in retirement? Do you plan to travel, pursue hobbies, volunteer your time, or even start, a new career or a new business? It's important to consider your expectations carefully because your retirement income plan will be designed to support the retirement lifestyle that you envision. And retirement is not a one size fits all, type deal. So it's a very unique personal endeavor, So some of the other questions, when do you plan to retire? As we'll discuss, the age at which you plan to retire can have an enormous impact on your overall retirement income situation. And how long will your retirement last? In other words, how long of a distribution period should you plan for? So we're going to spend a few minutes really trying to discuss the last two questions. As we mentioned, when you decide to retire really can have an enormous impact on your overall retirement income situation. Let's consider early retirement, for example. Most of us would like the chance to retire early, but early retirement really can have some pretty significant financial repercussions. First, when you retire early, you're giving up what could be prime earning years. These are years during which you could be making significant additions to your retirement savings because you're probably on the latter end of your working years. You're probably making, the highest income or close to the highest income that you've ever made or will make, and that can translate into higher contributions. In addition, the earlier you retire, the longer the period of time that your retirement assets will need to provide for your support, and therefore the greater the risk is that you will outlive your money. Also, you can begin receiving Social Security retirement benefits as early as age 62. However, if you start taking benefits at age 62, your Social Security benefit may be as much as 25 to 30% less than if you waited for your normal retirement age of 66 or 67, depending upon what age you were born. We'll discuss Social Security in more detail later on. Medicare, healthcare, you're not eligible for Medicare until age 65. And unless you'll be eligible for, health benefits through your employer or have coverage under a spouse's plan or take another job that offers health benefits, you've got to factor in the cost of paying for insurance or healthcare out of pocket, at least until you qualify for Medicare at age 65. Additionally, if you're covered by an employer pension plan, you want to check to make sure that your plan wouldn't be negatively affected by your early retirement. A lot of the greatest accrual benefits under a pension plan generally happen during your final years of employment, and it's possible that early retirement could effectively reduce the benefit that you receive. Okay. Now, as you may suspect, delaying retirement presents certain advantages when it comes to retirement income planning. The longer you work, the longer you'll be able to continue contributing to your retirement savings. And I would also add to that that, as you have higher account balances approaching retirement, those higher account balances lead to more dollars added through investment growth. Okay. Even if you're no longer adding to retirement savings, delaying retirement postpones the date that you'll need to start withdrawing from your savings. Okay. And a shorter distribution period could significantly enhance your savings potential to last throughout your lifetime. You certainly don't want to outlive those assets. Also, delaying retirement may mean that you can delay Social Security retirement benefits, which potentially increases your annual benefit when you do decide to start those. Continued employment may also mean continued access to company-sponsored healthcare. Okay, and so that can be either as a supplement to Medicare if you're working past 65, or in lieu of Medicare prior to retirement, or certainly prior to 65. Okay. Of course, if you plan to work during your retirement, that can certainly have an impact as well. I mean, the obvious advantage is that working during retirement, you'll be earning money, relying less on your retirement savings, leaving more in your savings to potentially grow for the future, and then helping to stretch those dollars, over your lifetime. Additionally, full or part-time work during retirement could potentially provide access to affordable health care. And if you do work during retirement, you want to make sure that you understand how the income you earn might affect your Social Security benefits. While your earnings may increase your Social Security benefits in future years, current benefits could be reduced. For example, for years before you reach your full retirement age of Social Security retirement age, again, 66 or 67, for the years before that, for every dollar in Social Security retirement benefits will generally be withheld for every $2 that you earn over the annual earning limit. Okay. So for instance, in 2021, that annual limit, we'll say from payroll income, is $18,960. So for every $2 that you earn over that limit, $1 of your Social Security benefits will be withheld if you started those Social Security benefits prior to your full retirement age. Okay. It's also worth noting, there's a lot of non-financial reasons that might motivate individuals to work during retirement. For example, you may value social interaction, a sense of accomplishment, structure that your career provides. Ultimately, you may decide that full or part-time work, or launching a career or starting a new business, might be the right decision for you. So again, there's a lot of financial benefits, socialization, a sense of purpose, structure, etc. There's a lot of benefits to working and delaying retirement. Okay. One last observation that I want to kind of speak to is, if you're working for an employer that offers a traditional pension, determine whether working part-time will impact your benefits. If your benefit is based on your final average pay, it's possible that working part-time could actually reduce your benefit. So it could be worth inquiring about any phased retirement program that your employer might offer. These programs basically allow you to receive all or part of your pension benefit while you continue to work on a part-time basis. Essentially, it allows you to double dip, so to speak. Okay. When it comes to your retirement plan, how long a period should you plan for? I mean, obviously, this is based upon life expectancy, and this is really the unknown variable. But as a financial advisor, financial planner, we would certainly rather overplan than underplan, when it comes to this particular variable. The good news is that we're living longer lives. The bad news, that generally translates into a longer period of time that that you'll need your retirement income to last, or the assets that are going to produce that income to last. According to the National Center for Health Statistics, the average 65-year-old American can expect to live for another 19 and a half, almost 20 years, okay? So life expectancy has increased at a steady pace over the years, and it's expected to continue increasing. And really the point that I want to make here is that for many of us, it's not unreasonable to plan for a retirement that lasts for 25 or 30 years, which means your income and savings will need to last that long as well. So just, something to keep in mind. Every retirement income plan basically has to balance three main goals. One is to maximize your ability to enjoy retirement. That means making sure you have the financial ability to do the things that you want to do. We want to minimize the chance that you outlive your money. And we also want to manage the financial risk of unwelcome life events such as serious illness, the need for long-term care, or other, unexpected expenditures for yourself or your family, okay? Once you know when your retirement will start and how long it may last, the type of retirement lifestyle you want, it's really time to estimate the amount of money that you'll need to make in order for all of that to happen, okay? And so we're going to talk a little bit about the process here. So first, you want to estimate your future retirement expenses to determine how much income you'll need during retirement. And you want to factor in the potential cost for healthcare and potentially long-term care as well. Next, you want to consider the major factors that will affect your retirement income. For example, you need to adjust your income estimate to account for inflation. And you also want to make sure you fully understand the potential impact of taxes and investment risk, okay? Then, total all your fixed income sources you expect to receive, which would include Social Security and any employer pension plans that you can count on. And when you compare your adjusted income needs to your anticipated fixed income sources, you'll likely find that you may not have enough income to meet your needs and goals. And so the difference between the expenses and the income, that shortfall is a gap, and it's an important part of your retirement income plan, because you basically have to supplement your first fixed income sources. In order to do that, you have to rely on your retirement savings, or your nest eggs, so to speak. How should you go about this, including the products and strategies that you should consider? Depends upon your current retirement assets, the amount of additional income that you need to generate, and the ability of you and your plan to tolerate risk, okay? So we're going to look at step one in the process, estimating how much income you'll need. When trying to figure out how much annual income you'll need in retirement, you may be tempted to rely on some general guidelines. So for example, you may hear that you should plan on needing somewhere between 60 and 90% of your pre-retirement income when you retire. I think using this type of guideline can be okay to use when you're early in your lifetime and trying to save and forecast. If you're in your 20s, 30s, 40s, maybe using this type of guideline to plan off of is okay. But I would say, instead of basing an estimate of your annual income needs on a percentage of your current income, as you get closer to retirement, you want to focus instead on your actual expenses today. Think about whether those expenses will stay the same, whether they'll increase, decrease, or even disappear by the time you retire. While some expenses may disappear, like a mortgage or costs for transportation to and from work, there's new expenses that could pop up. It could be expenses like yard care services, snow removal, home maintenance, things that you might currently take care of yourself, but may not want to or may not be able to do in the future during your retirement years. Okay, so you really gotta factor those things together. Okay, and I would say also you want to look at things as living expenses. What are the most basic living expenses that you need just to keep the lights on? And then, if you plan on travel or hobby activities, if those types of things are going to be part of your retirement, you want to be sure to factor those costs in as well. And those are what I would say are more of lifestyle expenses. They're not necessities. They're a little bit more discretionary. But generally, I think it's a good idea to look at both your living expenses and lifestyle expenses. Okay. This can be a very painstaking endeavor, just kind of listing out your expenses and sort of doing a budget, but you really do want to try to detail every potential expense that you can think of. Property taxes, auto insurance, homeowners insurance, birthday gifts, holiday gifts. I mean, there's so much that, we take on throughout the course of the year. Any debt that's being serviced, when is that debt going to be paid off? To really make sure you are accounting for everything is really important. For a lot of people that I work with, the difference of a few $100s, $1,000 a month in their expenses can sometimes make or break their financial plan. So it's really important to try to drill down in detail, what these costs are going to be for you. One major retirement expense to consider is healthcare. Once you retire, you're likely to focus more on healthcare than ever before, and there's a greater chance that your health will decline. Most Americans are automatically entitled to Medicare coverage once they turn 65. When you're eligible for Medicare, you've got to make some coverage elections. So, for example, you have to decide whether you want to purchase Part B coverage, which is for medical care, including physician care, laboratory tests, and physical therapy. Part B is an optional election. Part D is also an optional election, and you may want to consider joining Part D, which is basically prescription drug plan offered in your area by a private company or insurer that has been approved by Medicare. It's also important to understand that Medicare is not going to cover all your healthcare expenses. For some types of care, you'll have to satisfy a deductible, make co-payments, and that's why you might want to consider purchasing a Medigap policy that offers additional coverage. It's also important to understand that Medicare will not pay for long-term care needs if you ever need that. So when I talk about long-term care, I'm talking about, most folks refer to it as nursing home care, but I'm also referring to it as, if you need extended in-home care as well. Okay, Medicare is not going to pay for those long-term care scenarios. Okay. Because Medicare doesn't cover long-term care, it's important to consider the potential impact of a prolonged stay in a nursing home, or again, having that in-home care. So again, when I talk about long-term care, I'm referring to the ongoing services and support needed by people suffering from chronic health conditions or disabilities, and that care can either be in-home or out of home. Okay. It's hard to face the fact sometimes that our health is going to decline. Statistically, most of us will need long-term care during our lifetimes at some point after we reach the age of 65. Currently, the nationwide average cost of a one-year stay in a semi-private nursing home room tops $90,000 a year. Okay. In the future, that long-term care will likely cost even more. And if costs continue to rise, at an average of 3% every year, which quite honestly, from everything that I've seen, healthcare typically has an inflation rate of almost double everything else. So this is using an example of 3% a year. In 20 years, 1 year in a nursing home could cost approximately $163,000. Sorry, did that prematurely. And I would say it would probably, potentially cost more than that. Because again, this is just using 3%. And I think the inflation rate on healthcare is certainly more than that. So if you needed it, how would you pay for this care? You might consider paying out of pocket, which means using your income, savings, investments, other assets such as the home to pay for any potential long-term care. But paying out of pocket really is somewhat of a gamble, unless you're really wealthy. Okay. Many people assume that Medicaid will pay for long-term care costs, but what you've got to keep in mind is that Medicaid is a low-income program. Okay, so you may be able to rely on Medicaid, but there's a catch. In order to qualify for it, your assets and your income must be low enough to allow you to qualify. So you'll basically have to use up most of your savings or spend down your savings before qualifying for Medicaid. And aside from small personal needs allowances, you'll have to use all of your retirement income as well, including Social Security and any pension payments to pay for your care before Medicaid, will kick in. Okay. So especially for those clients that I have that are very legacy focused, the idea of qualifying for Medicaid and spending down your assets in order to accomplish that, just isn't really appealing. Not to mention, I don't know that you want, sometimes you get what you pay for. So, Medicaid is going to try to do things as inexpensively as possible. And I don't know that you want the state kind of taking care of your, your healthcare needs. So another option to consider is long-term care insurance. That could provide a source of funds for long-term care expenses. Doesn't ensure that you won't have to pay for some of the long-term care costs out of pocket. And obviously the premium for that insurance will also need to be factored into your retirement income needs. Okay. But a lot of times people just overlook the cost of long-term care and don't even factor that into their income needs or their financial plan. Okay. Before we move to talk about other retirement income sources, we're briefly going to review some of the factors that make retirement income planning somewhat of a challenge. The first is, even if you can accurately predict your retirement expenses and can calculate the exact amount of retirement income that you'll need each year, you have to adjust those calculations to account for inflation. Okay. Inflation is just the rising cost of goods and services. And generally speaking, Social Security income and pension income does not necessarily increase at the same level each year that, if inflation increases. Okay. You also have to keep in mind and account for the effect of taxes and what impact taxes will have on your income. On your assets. And then finally, your retirement income plan will have to balance your need for ongoing income with the level of risk that you're willing or able to accept. Okay. So those are just a few other factors to consider. So the first one we're going to talk about is inflation. I kind of refer to this as the silent stealer. So unless you accurately account for inflation, you're likely underestimate the amount of annual income that you'll need in your retirement years. The reason I call this the silent stealer is I kind of use the example, if you've got $100 in your purse or in your wallet, and I were to come in and steal $100 from you, that's pretty obvious. Okay. But if I were to just come in and take out, $3 at a time, multiple times, it's not quite as obvious. Did I spend that $3 somewhere? Did I drop it somewhere or give it away or whatever the case is? And that's kind of what inflation does over the year. It just sort of whittles away or chips away, at the effect or the purchasing power of your dollars. So inflation, like I said, is basically just the general increase in the cost of goods and services over time. In other words, the purchasing power of a dollar will likely decline over time due to the rising cost of goods and services. And at a 3% inflation rate, a given sum of money will lose over half of its purchasing power in a 25-year period. So put in another way, at 3% inflation, a gallon of milk that cost, I don't know, $4 today would cost over $8 in 25 years, okay? Keep in mind that inflation doesn't affect all goods and services equally. I already threw out there the idea that healthcare costs have a higher inflation rate than 3%. That's something that is very important to factor in. And so when I'm doing a financial plan for folks, we kind of separate living expenses from healthcare expenses because the inflation rates on those are really two different things. So all other things being equal, inflation means that you'll need more income each year just to keep pace, okay? So it's very important for your plan to account for rising income every year in retirement to offset inflation. So, if you've got a pension plan that's flat, that's not going to go up year over year, Social Security isn't going to go up a lot over the years, it's important to have a plan in place that allows rising income for you, okay? The impact that taxes can have is sometimes overlooked as well. It's not about what you make or what you have, it's about what you get to keep. And sometimes I'll have folks that come in and all the dollars that they have saved up are in 401ks or traditional IRAs, which are all pre-tax vehicles, okay? So what often people fail to realize is you don't own all of that money, okay? Uncle Sam owns a percentage of that. For example, if you've got a $100,000 IRA or 401k, you probably only own, $80,000 of that or $70,000 of that because the rest of it is going to be owed in taxes as you start making withdrawals. So, taxes can certainly eat into your income, reducing the amount you have available to spend in retirement. And you want to make sure that you understand whether income that you're counting on is or is not subject to tax. For example, many are surprised to learn that a portion of their Social Security retirement benefits may be subject to federal income tax, depending upon your filing status and total annual household income. Okay, so you want to make sure that you understand how your income is going to be taxed. Keep in mind that some income, like interest, is taxed at ordinary income tax rates. Other income, however, like long-term capital gains, qualifying dividends currently benefit from special, generally lower maximum tax rates. Some specific investments like municipal bonds generate income that can altogether be exempt from federal income tax and sometimes state tax as well. You should also understand how distributions from tax advantaged accounts like traditional IRAs and 401ks are taxed, generally to the extent that a distribution from the account or plan represents earnings or pre-tax contributions, or in the case of an IRA, deductible contributions, the distribution for the most part is going to be taxed as ordinary income, okay? Now, regardless of whether investments within the account may have generated long-term gains or dividends, it doesn't matter if the account has grown, it's still going to be taxed as income as you make a withdrawal. There are certain rules and special rules that apply to Roth IRAs, Roth 401ks, Roth 403bs, Roth 457s or TSPs. Generally, those distributions are not going to be taxed, okay? mainly because the contributions that went into those accounts were funded with after-tax dollars, okay? So again, you just want to make sure you're aware and that you understand, have a good idea of how your income and your various withdrawals from different types of accounts are going to be taxed and its impact upon your income during retirement. Now, different types of investments carry different risk, okay? So sound retirement income planning really involves understanding those risks and how they can influence your available income in retirement. And so there's, a few areas of risk that need to be accounted for. The first, and probably what most people think about, is investment or market risk, okay? It's the risk that fluctuations in the stock market or securities market may result in the reduction or the depletion of the value of your retirement savings, okay? It's when it comes to market risk, I mean, that is risk, for folks, but there's been a lot of times when I'm putting together a financial plan for folks and market risk is not the most important risk that people encounter. It's not necessarily market risk that's going to prevent someone from achieving all their goals. In a lot of cases, it's health risk, okay? And that's not one that's been listed on here, but I'm going to throw out health risk on there. You also have what's called reinvestment risk. So this is the idea that if your investment is associated with a fixed interest rate, like a bond or a CD, we're seeing a lot of this right now, okay? It's the idea that when that CD matures, a CD that you were previously getting 3% on, maybe 4 or 5 years ago has matured, and now you go to renew it and interest rates are currently at 1% or less, okay? So it's that idea of reinvestment risk. There's also interest rate risk. So that when interest rates rise, the price of some investments will drop. For example, during periods of rising interest rates, newer bond issues will likely pay higher coupon rates than older bond issues, and it basically decreases the market value of those older bonds, okay? Recessionary risk. It's not one that's on here, but it's the idea that we have long-term market declines, okay? Not something like we saw last year with what I would call the COVID drop, where the stock market was down 30% basically in 30 days. Things recovered from there pretty quickly over the course of the year, and 2020 ended up being a positive year for stocks. But from a recessionary risk standpoint, if we have a declining markets for 2, 3, 4 years, that will certainly play an impact on people's retirement income and their financial plan, okay? Pension risk. Sometimes I've worked with folks and they've either had to take a cut in their pension or they've gotten a request for a buyout, okay, where mainly the company's wanting to pay them a lump sum amount so that they're not obligated to pay them a monthly amount any longer, okay? So either buyouts or a decrease in pension is another form of risk, okay? So a lot of things to consider other than just investment and market risk. So after you've estimated the amount of annual income that you're going to need in retirement, it's time to determine basically how much annual income you can already count on, okay? Traditionally, retirement income has been described as a three-legged stool, okay? It would be made up of Social Security retirement benefits as one leg, traditional employer pension income as the second leg, and then whatever you've accumulated in your individual savings and investments or your nest egg kind of makes up the third leg. Now, most folks do not have an employer pension plan any longer. Okay. So the first two legs of the stool, Social Security benefits and pensions, they typically will produce a relatively fixed stream of annual income that you can depend on. But like I said, most people don't have a pension plan any longer. So that means the third leg of the stool, which is individual savings and investments, is going to play a bigger role in funding retirement for those individuals that don't have a pension. Okay. But we're gonna kind of look at the first two legs of the stool, which is Social Security and employer pension income. Okay. Today, 97% of those age 60 to 89 either receive Social Security or will receive it. Okay. The amount of Social Security retirement benefit that you'll receive is based on the number of years that you've been working and the amount that you've earned. Your benefit is calculated using a formula that takes into account your 35 highest earning years. So think about that. Kind of going back to the idea for those folks that want to retire early, you're giving up premium earning years later on, which not only is going to affect your savings and your nest egg, it's going to impact your Social Security benefits as well, because you could be replacing earlier, lower income earning years with later, higher income earning years, because it's going to utilize the 35 highest earning years. The best way to know how much you can expect in benefits is basically to go to ssa.gov and sign up for my Social Security account. You'll basically, build your profile through ssa.gov. Utilize your login credentials, and you can access your Social Security statement online. Social Security statements generally are not mailed any longer. You have to access those through ssa.gov. Okay. The earliest that you can begin to receive Social Security benefits is at age 62. And if you decide to begin receiving those benefits before normal retirement age, which again ranges from 66 to 67, there's a significant drawback. Your monthly benefit will be permanently reduced. Okay. And as I mentioned earlier in the presentation, that could be reduced as much as 25 to 30% versus if you waited until your full retirement age. Now, conversely, you get a higher monthly payout by delaying benefits past your normal retirement age up to age 70. Okay. So even though by taking retirement benefits at 62, you're getting a smaller benefit monthly benefit, you'll end up receiving more benefit checks. You get it for a longer period of time. For example, if your normal retirement age is 66, opting to receive benefits at age 62 means you'll receive 48 additional monthly benefit payments. Of course, they're at a lower amount. A lot of times what I do with financial and the financial planning element of things, we look at, kind of what is the break-even age when you're evaluating your benefits at age 62, full retirement age of 66 or 67, and age 70. Okay, what is the break-even? How long do you have to live before delaying those benefits would give you more dollars in your pocket? We've already mentioned that working in retirement can also have an effect on your Social Security benefits. That's just something you want to keep in mind. It's also worth noting that federal government periodically adjusts Social Security benefits for inflation, but the idea that those benefits are going to keep up with inflation, typically that hasn't been my experience in seeing that. Okay, so the bottom line is for most people, Social Security alone isn't going to provide enough income during your retirement years. Okay. Let's speak for a moment about employer pensions. If you're entitled to receive a traditional pension from an employer-sponsored pension plan, you're really lucky because, again, fewer Americans are covered by plans every year. If you haven't already selected a payout option, you want to make sure you carefully consider those choices. Sit down with someone and make sure you fully understand what you're signing up for. Generally, your retirement benefit is an annuity. It's a single life annuity payable over your lifetime, beginning at the plan's normal retirement age, which is typically 65. Many plans allow you to retire early, but you're going to have to adjust your benefit to account for the fact that payments begin sooner and therefore will last for a longer period of time. The single life annuity is probably going to be the highest payout option because, quite honestly, the pension plan is kind of betting, so to speak, that you're going to pass away sooner, and you're kind of betting that you're going to live longer. Okay, but basically, once you pass away, those payments will stop under the single life annuity option. Okay, if you're married, your plan must generally offer you what's called a qualified joint and survivor annuity. Doesn't mean you have to take it, but they have to at least offer it to you. Okay, so a qualified joint survivor annuity provides a monthly payment for as long as either you or your spouse is alive. Okay, there's a percentage of that payment that will go to the survivor. The payments are generally smaller than the single life annuity option because they have to pay out for 2 lifetimes instead of 1. Okay, sometimes that survivor benefit can be decreased as much as 25-50% depending upon which election you take. Okay, your plan may offer other options as well, including the option to take a lump sum distribution. So the option really that's right for you depends upon your individual situation, including your age, your spouse's age, health, other financial resources. So again, make sure you completely understand all of your options before making a decision. That's something that I do often is sit down with folks, do kind of a pension analysis, and make sure folks understand fully what they're choosing for their pensions, because that is an irrevocable decision. Okay, and so it's a very important one. You also want to make sure that you know whether or not your pension benefit will be adjusted periodically for inflation. Okay, prior to retirement, your pension plan will provide you with an explanation of all your options. Mainly, it's called a summary or an explanation of benefits and the relative values of any optional form of benefits available to you. Okay, so be sure to read through that. Make sure you're getting that in a timely manner. Okay, we're going to pause for just a moment. The idea here is that if you compare the annual income that you're going to need in retirement to the annual income you can count on from Social Security, pension benefits, again, you're likely to find a gap. Okay, unless you're really lucky to have enough, we'll call it secure income between those sources with a generous pension, you're going to have unmet retirement income needs that will generally have to be funded from your personal savings and investments. And so when we're talking about your personal savings, your nest egg, we're talking about funds that you have in tax advantaged accounts like IRAs, 401ks, 457s, 403bs, TSP, as well as any investments you hold outside of tax advantaged accounts. Okay, so when it comes to putting together a plan to convert your personal savings into a source of retirement income that fits your needs, there's several factors to consider. First and foremost, the challenge is to implement an investment strategy that provides with reasonable certainty for the annual income that you will need, while balancing that need for regular income with other considerations such as liquidity, your risk temperament, anticipated rate of returns. Asset allocation is deciding how much you'll put into various types of investments And that's going to be an important part of your strategy. Beyond general asset allocation, you should become familiar with specific investments and products that can play a role in your overall investment strategy. This is where it can make a lot of sense for you to sit down with a financial advisor. I see a lot of times folks who I call the kind of the do-it-yourselfers. They really don't have an understanding or even know what types of products and services exist out there that can really help mitigate a lot of their risk that they're trying to manage on their own. Okay. So again, take some time and spend with an advisor that you are confident in and learn about some of these other options, these programs that can really play a key role in managing your financial plan. Okay. Withdrawal rate is the portion of your portfolio that you'll liquidate each year for income. We're going to spend a little bit more time on that in a little bit. But the question that you'll need to answer is how much can you withdraw each year without exhausting or outliving your savings? Thought needs to be given to the order in which you tap various accounts. For example, tax considerations can affect which accounts you should use first and which ones you should draw from last. You also want to consider up front how you'll deal with required withdrawals or required minimum distributions from tax advantaged accounts like 401ks and IRAs, and whether they'll be a factor at all. Those required minimum distributions used to start at 70.5. Now it's 72. So that legislation was updated, I don't know, I think back in 2019. So those required minimum distributions do not have to start until age 72. During your accumulation years, your asset allocation decisions may have focused primarily on long-term growth. You were probably, more aggressive during the early years of your life as you're, starting your career. But in retirement, the demands on your portfolio are likely to be very different. Keep in mind, you're transitioning from your early years of growth and accumulation, you're transitioning to income and distributions. And that is a whole different ballgame, okay? So, when you were saving early on, as long as your overall portfolio was earning an acceptable average annual return, you were probably happy. Now that you're planning to rely on your savings to produce a regular income, the consistency of year-to-year returns and your portfolio's volatility may assume much greater importance for you. You're going to be much more sensitive to fluctuations in your account values in retirement than what you were when you were working. Because keep in mind, while you're working, you're making continued contributions usually into your retirement accounts, and those additions can sometimes disguise any losses that the investments incurred, during down markets. Well, now that you're retired or preparing for retirement, when you don't have any additions going into the account, you're going to be much more sensitive to the volatility and the fluctuation of those account values. And so it's important to make sure that your asset, the amount of risk that you're taking, is in line with your risk temperament. I always tell folks, losing 20% on $1 million account hurts a whole lot more than losing 20% on a $50,000 account, okay? And so when you retire, your balances are probably the highest they're ever going to be. You're not making any additions into those accounts any longer. Again, you're going to be much more sensitive, to the volatility and the fluctuations of those accounts. Balancing the need for both immediate income and long-term returns is a tough challenge. If you invest too conservatively, your portfolio may not be able to grow enough to maintain your standard of living. If you invest too aggressively, you could find yourself having to withdraw money or sell some of the stocks at an opportune time when the market's down, which would also jeopardize future income and undercut your long-term retirement plan. Without proper planning, a market loss that occurs in the early years of your retirement could be devastating overall and reveal itself later on in the later years of your retirement, okay? So asset allocation alone does not guarantee a profit or insure against a loss, but it can help you manage the level and types of risks that you take with your investments based upon your specific needs. An effective retirement asset allocation plan basically provides an ongoing income needed to pay for expenses. It minimizes volatility to help provide both reliable current income and the ability to provide income in the future. And I would say, keep in mind, you want to provide rising income in the future, okay? An effective asset allocation plan will maximize the likelihood that your portfolio will last as long as you need it to, which is your life expectancy. And it also keeps pace with inflation in order to maintain, proper purchasing power over time. Again, rising income, okay? Your retirement income plan depends not only upon your asset allocation and your investment choices, but it also on how quickly you draw down your personal savings. So we're going to talk a bit about withdrawal rates, okay? Basically, you want to withdraw enough to provide the current income you need, but not so much that you run out too quickly, leaving nothing for later retirement years. The percentage that you withdraw annually from your savings and investments is called your withdrawal rate. The maximum percentage that you can withdraw each year and still reasonably expect not to deplete your savings is referred to as your sustainable withdrawal rate. So I'm going to show you this study. This is called the Trinity study. And what you're seeing here is different withdrawal rates and the likelihood that those assets are going to be able to sustain themselves over 15, 20, 25, 30 years based upon the allocation of the portfolio, okay? So for example, let's start out real easy. If someone's got a $100,000 account at a 3% withdrawal rate, that account would basically give them $3,000 a year, okay? If you're able to live off of just, that extra $3,000 a year on top of pensions, on top of Social Security, then really it doesn't matter how aggressive you are or even how conservative you are. Even if you're 100% in bonds, from this chart, you can see at 3%, even in a 100% bond portfolio, there's an 80% likelihood that that money is going to last for 30 years, even if you're in 100% in bonds. There's a 100% likelihood that that money is going to last, in whatever your allocation is, okay? But as you can see, the higher the withdrawal rate, meaning the more income that you need off of your nest egg, you're decreasing the likelihood that those assets are going to be able to sustain themselves. And so you can see where I've got things kind of color coded here. Generally speaking, I'm going to say withdrawal rates of 3 and 4% of your account balances are relatively safe withdrawal rates, unless you're getting really ultra conservative in your portfolio and need those funds to last, 25, 30 years. You start getting into 5, 6, and 7% withdrawal rates, better proceed with caution. And 8, 9 or higher percent withdrawal rates, like I wouldn't even go there, okay? Because that money is not going to last, unless you only need it to last for 10, maybe 15 years, I wouldn't even go into those level of withdrawal rates, okay? But this just gives you an idea of what level of withdrawal rate you can safely take over what period of time based upon a broad, guideline as far as allocations of the portfolio, okay? Withdrawal rates are very important. And, there's a lot of strategies and a lot of models that are used to calculate sustainable withdrawal rates. And some suggest withdrawing a fixed percentage each year. Some promote a rate based upon your investment performance each year. Some recommend a withdrawal rate based on age. Factors to include the value of your savings, the amount of income you anticipate needing, your life expectancy, the rate of return you anticipate from your investments, the effect of inflation, the effect of taxes, and whether you're planning for 1 or 2 retired lives. Okay, so there is a lot that goes in to that plan and developing a plan that is sustainable. To give you some idea of the percentage that we're talking about, like I said, there's a basic assumption that an appropriate withdrawal rate falls somewhere in 3 to 4% range. Okay, so that 3 to 4% is what we're going to typically use as a sustainable withdrawal rate. It's also worth noting that your withdrawal rate is particularly important in the early years of your retirement. That's because withdrawing too much early on can have a significant impact on how long your savings will last. I'm going to show you this example. There's a lot of information on this slide. I hope I can do it justice. But this is talking about the sequence of returns. And what you have here in this example is Jim. He's age 65. He has a $500,000 nest egg that he's investing in an index fund. Okay, so an index fund is just something that's going to mirror the performance, in this case, of the S&P 500. And he begins taking out 5% a year, so $25,000 a year for income. And you've got 2 different scenarios here. Okay, you've got scenario A, which basically shows the effect of that index fund, the growth of that index fund from 2000 to 2017. Okay, so keep in mind, in year 2000, 2001, 2002, we had the tech bubble pop, we had 9/11, and we still incurred that in 2002. So in scenario A, that portfolio was declining the first 3 years. Okay, and he's taking out $25,000 a year. In scenario B, what it's doing is it's just turning upside down the order that those returns came in. It's the same returns over the same period of time. It's just reversing the order that those returns came in. So instead of starting out in a negative return environment like scenario A, he's starting out in a positive return environment and ending his life with a negative return. Okay, so look at the difference the sequence of returns can play on the success of a retirement plan. Okay, in scenario A, again, he's taking withdrawals as the market's going down in the first few years, and then the market goes up after. At the age of 83, his portfolio is worth $20,000. Okay, if you flip-flop the order of those returns, that same scenario or those same returns, just flip-flopping the order, at age 83, he has $477,000. Here's the kicker. Keep in mind, in both scenarios, the average rate of return is the exact same at 4.95%. So it's not a matter of a difference of how the investments performed. It's a matter of the order that those returns came in. Okay. And what's unfortunate is when you're entering into retirement, you don't have a crystal ball to know, what type of environment are you entering into? For those folks that are planning on retiring in the next, 1, 2, 3 years, the market's up, right? It's pretty richly valued. You could be entering into an environment that's more like scenario A versus scenario B. And so the reason I say that is because, there are some investments that you can utilize. I would say in scenario A, one investment option that he could have utilized to help this would be an annuity, because what an annuity is going to provide is that even if the account balance goes to 0 he'll still get $25,000 a year. Okay. So in scenario A, he could have used an annuity. In scenario B, he probably didn't need an annuity, but hindsight's 2020. And so, that's where you've really got to take into consideration all the different variables. All the do-it-yourselfers out there would say, you know what, if I put a plan together that averages 4.95% a year, my retirement should be successful. But what they're not factoring in is an illustration like this, where sequence of returns and the order that those returns come in is really very important. The other thing that's not being factored into this in both scenarios is an inflation adjustment. This scenario is showing him taking out $25,000 a year every single year with no rising income. Well, $25,000 a year at the age of 65 is not going to go as far and last as long as $25,000 a year at the age of 83, 84, 85. So both of these values, I would say, are somewhat overinflated because it's not providing a rising income scenario. Okay. So that, again, is something else that you've got to consider. A well thought out asset allocation plan is really essential both before retirement and after. But consideration must also be given to specific investments that you choose. There's many different investment options, and it's impossible to discuss them all here, today. But nevertheless, it's worth mentioning a few choices that might have a place in the income producing portion of your overall investment strategy. Bonds can help you address investment goals in many ways. Buying individual bonds at their face value, holding them to maturity, that could be an option. Dividend paying stocks could be an option. Dividends, aren't guaranteed though. A lot of times companies will, decrease their dividends if the company's not doing well. So you've got to be prepared, to adjust your portfolio based upon if the dividends are changing. Some other alternatives might include, CDs. Well, right now, I think people are aware of what the rate, the fixed rate environment is. I think our 5-year CD is less than 1% at Wright-Patt. So, CDs are not providing the level of income that generally people need. You can look into TIPS or Treasury inflation protected securities. Distribution mutual funds that are really designed to provide an income stream from year to year, but there's no guarantee that that income will last, as long as the fund is predicted. Okay. I mentioned annuities. That's another option that has become somewhat synonymous with retirement income. Okay. And we're going to spend a little bit of time on annuities. I'm not really advocating for or against annuities. I think that they have their place for people. But again, it's a very personal type of decision. I want to just kind of give a summary of what an annuity is. It's a contract between you and an annuity issuer. In most terms, you pay money, a premium or multiple premiums, and in exchange, the issuer or the insurance company promises to make payments to you for a fixed period of time or for the rest of your life. Okay. Annuities are able to offer something unique. They can offer a guaranteed income stream for the rest of your life or for the combined lives of you and your spouse. And one thing that is nice about annuities when using them for income purposes, they can be very predictable. You can, through the guarantees, and you're seeing down at the bottom, guarantees are subject to claims paying ability of the annuity issuer or the insurance company. But, those guarantees allow a lot of predictability when putting together a financial plan. In return for this guaranteed income stream, you generally are giving up control of your funds. I want to stress that's the idea of annuitization. Same with the pension. When you're relinquishing control over that asset, a pension is basically funding an annuity that gets annuitized. So that idea of annuitization is the idea that you're relinquishing control over that asset. That is not something you have to do. okay? Annuities can be used for other reasons, but annuitization is always an option. It's not one that I usually recommend for folks, but when it's talking about giving up control of your funds, that's the idea of annuitization. So when you annuitize an annuity, they're no longer, it's no longer a liquid asset. It's designed to give you a fixed income, per month or per year. Annuities often provide a great potential for return as other investment options. They tend to provide a lower rate of return because you've got to account sometimes for the extra cost associated, for the annuities and the guarantees that it's providing. So you want to factor in fees and expenses. The bottom line is, though, annuities can be a full or a partial solution for folks when it comes to retirement income planning, since they can offer stable, predictable income payments. But again, I want to emphasize here, they are not right for everyone. I do a workshop or a webinar called the Lowdown on Annuities. I would really encourage you to attend that. The next one that I have is June 9th at noon. And, I tend to teach that webinar, a couple times a year or so. I think there's a lot of misinformation and misunderstanding around annuities. And I think it's important to have a webinar that's all on its own designated, toward annuities. Okay. So again, I want to encourage you to maybe attend that. We're winding down here, guys. You may have assets and accounts that are tax deferred. We talked about traditional IRAs. There may be some that are tax free from Roth IRAs. Given a choice, what type of account should you draw from first? Well, one approach basically is to consider is withdrawing money from taxable accounts first, then tax deferred accounts, and then any tax-free accounts you would withdraw from last. The idea is that by using your tax favored accounts last and avoiding those taxes as long as possible, you'll keep more of your retirement dollars working for you on a tax deferred basis. Now, that's not always the best strategy. If you're concerned about leaving assets to beneficiaries, estate planning concerns might influence your withdrawal decisions. For example, if you if you have an appreciated or rapidly appreciating asset held in a taxable account, in some cases, it may make sense for you to withdraw assets from your tax deferred or tax-free accounts first. The reason being is because appreciated assets held in a taxable account generally receive a step-up basis at your death, while assets held in a retirement account do not, okay? And so with, so many other things when it comes to retirement income planning, there's no easy answer. It's not a wide brush that applies to everyone. The decision over the order in which you should make withdrawal really depends upon your individual circumstances, your asset allocation, tax consequences, withdrawal fees, surrender charges, personal goals, and so forth. There is one aspect of retirement withdrawals that isn't discretionary. With some accounts, even if you don't want to withdraw the funds, you may have to. We're talking about required minimum distributions at the age of 72 from IRAs, 403Bs, 401Ks, those tax deferred type of accounts. And, due to the coronavirus aid relief, those required minimum distributions were waived in 2020. They do resume in 2021. So make sure you're taking those required distributions this year. Okay. Other potential sources of income, that we haven't really discussed at all. There are sources of retirement income that potentially may be available to you. For example, if you have a mortgage that's paid off and you build up a substantial amount of home equity, it's possible that you could tap that equity as a source of retirement income by either selling the home or possibly downsizing, or by borrowing against the value of the home, I would say that should be explored with caution. You know, there's a lot around reverse mortgages these days. To me, that's kind of a last resort, you know, last case scenario. Um, Another example could be existing permanent life insurance policy that has cash value, can sometimes be a source of retirement income. Although policy loans and withdrawals can reduce the cash value, reduce or eliminate the death benefit of the policy, and have some negative tax consequences. So again, you know, proceed with caution. One of the, you know, we just kind of want to recap, you know, just some of the questions to maybe consider. You know, when do you plan to retire? How long a period you should plan for? How much annual income you will need? How much annual income can you expect from Social Security, employer pension, and so forth? And then, you know, personal savings and how that's going to impact your retirement plan as well. Okay. One of the statistics on the first screen was that only 11% of pre-retirees have a formal financial plan. And so the reason that I'm bringing that up is because that's something that, to me, I think is very important. All of these questions on here are very personal, and I encourage you to work with a financial advisor who's going to help you develop a comprehensive financial plan that is tailored to your specific goals, your needs, and your risk. And so I want to basically just kind of share with you a little commercial about some of the planning that we do here at Wright-Patt. And, you know, if this is something that you might be interested in, I want to encourage you to seek out one of our advisors. Okay. So just give me a minute. Hopefully you can hear this okay, but it'll only take a couple minutes. All right, guys, let me see if we have any questions. Here's one concerning funeral expenses. I found that funeral insurance is high, so I'm saving for the inevitable and therefore self-insuring. I'm also leaning into debt reduction to maximize my income benefit in retirement. You know what? I mean, I think that can be very smart. I mean, I have different, when it comes to life insurance, I think there's different solutions for everyone. I'm not going to go into that right now. Obviously, by doing debt reduction, you're trying to reduce the amount of expenses or the requirement that you would use or need, during your retirement years. So anytime you can reduce those expenses, I think that's really smart. I don't really have any other questions here. I do want to thank you for attending. There is a short survey when you exit out. There'll be a short survey. It's only like 4 questions. Please just take a couple minutes and maybe answer those questions. Certainly, if you have more specific questions, here's my contact information. I mainly work out of our offices over in Beaver Creek. I'm not really working in member centers at this point, but you're welcome to give me a call, shoot me an email. We can do a WebEx meeting if we need to, but I appreciate you attending tonight. And if you have any questions, don't hesitate to reach out. Thank you, and that concludes our webinar tonight.